webinar, gezoom en geteams, maar ek is bevrees dit gaan deel van ons lewe bly. Ek en Johan Barkhuisen, wat julle daar op die skerm kan sien, gaan probeer om die volgende halfuur. Ons dink ons gaan elkeen so plus minus 15 minute praat. Gaan ons so goed as moontlik probeer gebruik en dan gaan daar geleentheid vir vrae wees op julle skerms. Ek dink julle is al reeds vertrou daarmee. Aan die onderkant is daar 'n Q&A blokkie. Tik gerus julle vrae daarin. En ek gaan, nadat ek die inleiding gedoen het, 'n bietjie perspektief gee, 'n bietjie praat oor die besigheid, en dan gaan Johan die res doen. Julle is natuurlik vry. Ek ben baie keer is investment of beleggingsgesprekke relatief boring, so julle is welkom ten enige tyd te verlaat, maar hopelik maak ons dit so interessant as moontlik. Van die vrae wat natuurlik by my opkom, en ek dink by julle opkom, en dis normaal, want ons almal is beleggers in die fonds. Eerstens is, het julle nie dalk te veel Nasdaq aandele nie. Julle performance tot Augustus was great geweest, maar die laaste 9 maande beweeg dit sydelings. Is julle aandele blootstelling nie te hoog nie. Verskoon my, ek gaan van tyd tot tyd op my Cryptnotes hier links van my kyk. Randsterkte het julle natuurlik gekortwiek. Wat nou? Het julle nie 'n geleentheid in Maart 2020 gemis nie? Wat gaan julle doen op die pad vorentoe? Maar miskien, voor ons daarby kom ons reflekteer 'n bietjie, want dit was 'n ongelooflike jaar. En op die persoonlike front, voor ons na die grafiek kyk wat Johan op die skerm gebring het, moet ons net sê dat die afgelope jaar het een van ons kollegas, Donald Fulp in Amerika, lewer- en longoorplanting gehad. Dit het baie goed gegaan. Hy probeer nog 'n bietjie herstel daarvan en ons wens vir Donald die beste toe. Op my persoonlike front, en die wat weet, wat na my WhatsApp foto kyk, sal weet ek is 'n trotse oupa, so my kleinseun is môre 'n jaar oud. En ek is seker daarvan dat op almal se lewens groot goed gebeur. Nou die afgelope jaar, the past 12-month period has been unbelievable. If you look at that graph, what you see in front of you is the nominal GDP growth on an annual basis, and that red line that you see at the bottom is the biggest one that we've ever seen, the biggest one that I've experienced. My working career goes back to the mid-1980s, and we had a fantastic run-up, although it doesn't look like it there, before the 87 crash, and then again the run-up to the dot-com bubble in 2000, and then we had a fantastic period, let's call it the Mandela and Mbeki era, and then the slide that had happened under Jacob Zuma, and we've obviously during that time also had the 2008-2009 crash, but as you can see, compared to what we've experienced last year, that was a small fry, so a significant event. We need to sort of put that into perspective, because typically economic cycles have a knock-on effect on financial markets. And you may recall that over the last year, many commentators spoke about the L-shaped recovery, basically not going to recover, the U-shaped recovery, the V-shaped recovery, and I think we now have the J-curve recovery, because the bounce has been nothing but astounding. With hindsight, one can ask, have we wasted a crisis? Because in every crisis, there's an opportunity. And if we actually look back, and Johan, if you can give us the next slide, you'll see that the all-share index, the South African all-share index, for the year till the end of March, and maybe I should just dwell on that for a moment. Financial performance or investment performance typically gets measured in calendar years and then calendar quarters. So we talk for the year till the end of March. You will see that the South African equity market did 54%, whereas the Rootstock fund did 16%. We'll get to currency in a second. But it begs the question, did we not miss an opportunity because we only did 16, which I think is very credible, and I'll come back to in a second, compared to the 54% that the South African equity market did. However, the South African equity market's rise was very narrow because it was a resources and commodity market. And I must admit, it's a little bit like, are we sorry that we haven't participated in the cryptocurrencies and the rise in Bitcoin? And I'll tell you a Bitcoin story a bit later. Of course we are, but we did not have the balls to buy Sasol at the bottom, because we could have made almost 500% if we had bought Sasol. We could have bought platinum shares, and we could have made between 200 and 300% on platinum shares. But if we actually cut through it all and we leave the commodity shares and Sasol aside, other than Naspers and Richmond, where we've obviously had a Naspers exposure, the rest of the market are still pretty much well below the pre-COVID levels. So ignoring resources, ignoring the two shares that I've mentioned, and the two other exceptions, and we may get to that during question time. One is Capitec and the other one is Transaction Capital. All the banks, all the retailers, all the insurers are still between 20 and 50% below their pre-COVID highs. And I think that if you reflect on the actions of other fund managers, big houses sold out of their commodity exposure right at the bottom. We never had, so we never did that. But I'm quite proud that we haven't lost our nerve and sold at the bottom. And I think it's with a great amount of pride that we weathered the COVID storm. If we move our eyes to the sort of last two columns on that slide, the one aspect that we did get completely wrong is the exchange rate. Jan Smuts was right when he said, South Africa is the place where you always expect the worst, but it never seems to happen. In a nutshell, over the last year, the rand moved from 19 to 14.5. And that thankfully was due to strong commodity prices and also agricultural prices. So commodity prices and a strong balance of payments, as well as reversion to the mean, contributed to the strengthening in the rand of some 17%. So our exports, as you know, all the commodities such as iron ore, platinum, ferroalloys, coal, etc., and agricultural products has caused South Africa to run significant trade surpluses. In January, it was 12.4 billion versus 2.7 the previous year. In February, 29 billion, and in March, 53 billion. All in all, very, very good news, because when the South African currency strengthens, it's good news for all of us, and we are, as South Africans in dollar terms, become a lot more wealthy. However, if we look to the right-hand side, you'll see that there's an inflation column, and then there's the rand depreciation, other than this last year where it strengthened, depreciation column. And if we look right at the bottom, since inception, the rand depreciates per annum more or less in line with the inflation in South Africa, and that is to be expected. That's economic theory dictates that should happen. Over the past 10 years, the rand's depreciation has been 8.1% versus inflation of 4.9%. And I think we've all just sort of recalled that the last 10 years almost can be regarded as the Zuma demise and decline, but it's been a very volatile period, because you'll see over 5 years the currency hasn't depreciated at all, and the currency has actually strengthened quite significantly. So it begs the question, where to next? And while the currency in the short term, we believe, and currency forecasts are very dangerous, in the short term can strengthen, I don't believe, or we don't believe, trees go to the sky. In time, the commodity cycle will turn down. In time, our exports will pick up and trade will normalize. If we look at the structural shortcomings, there are many. And it's interesting that we've actually just heard when the president of the country and of the ANC testified in front of the Zondo Commission that they still don't want to abandon the anti-meritocracy, anti-jobs for pals, and the sort of cadre employment insanity. That is still part and parcel of what's happening to us. More concerning, if we look on the next slide, is that we sit on a bit of a time bomb as far as unemployment is concerned. What you see there is that almost 70% of young people between the ages of 15 and 24 are basically unemployed. And to add insult to injury, the South African Democratic Teachers Union make it almost impossible to employ school leavers because the quality of the individuals leaving school is subpar. So if we look at the short term, the rand, we were wrong. The rand has strengthened significantly. We think that things will normalize, and in time it should depreciate by the inflation differential. Unfortunately, we have structural shortcomings in our economy. You may recall about a year ago, we had a webinar where Professor Johnny Peter, Graham Codring, and myself spoke, and I had perhaps some uncalled for advice for the president to get the economy going after the COVID lockdown. And I think a great deal of progress had actually been made, but obviously helped by the mining and agricultural boom. However, the economy still is not entrepreneur friendly because ultimately, as I said at the time, entrepreneurs are the only ones that really create jobs. So the response can be summarized as the good, the bad, and the ugly. The good, company tax rates have come down. So far, the government has succeeded in keeping the government wage bill flat. But as you know, it ain't over till it's over. It ain't over till the fat ladies in the civil service is going to sing. A great deal of progress has been made with Eskom and with the independent power producers. And for those of you that have the opportunity, please go and listen to the journalist Sikonyani Manchacha that has moved over to become the Eskom spokesman. I think great progress has been made there. Great progress has been made, or some progress has been made on the anti-corruption front. We've still to see someone in an orange suit, but well done with the fact that Ace Magashule, the snake of all snakes, that has been suspended. And unfortunately, if people like myself support the politicians, it actually weakens their hand, and that's unfortunate, but well done. Then lastly, I think good progress, even though it doesn't create jobs, has been made in the distribution of social grants. So that was the good. The bad, I can't understand Mr. Pravin Gordhan's obsession with SAA. It's going to cost us more money, no doubt. However, the Treasury seems to be holding its line as far as other state-owned enterprises are concerned. Labor unions are still way too dominant, which makes it difficult to get labor-intensive industries off the ground. And then an unnecessary, I think, fixation on radical economic transformation and expropriation without compensation are unfortunately contributing to the grouping of what I would call bad. And then the ugly, my words that barely left my lips about the gangsters in the cabinet that's going to lick their lips to get their hands on the 500 billion relief package that was announced some 12 months ago. And as you know, those closest to the president got their hands in the cookie jar. The rolling out of vaccines present yet another opportunity for those to help themselves. And then lastly, and I've already referred to it, the whole issue of cadre deployment and incapacity and incapability within the civil service is a huge thing. Having said all of that, as Dr. Dani Craven would have said, look at the scoreboard. And the scoreboard says the rand has strengthened from 19 to 14.5. So I think that the market, because ultimately the currency is like a thermometer of the health of a country. So the currency is saying there's been great progress that has been made. But I'd like to caution that economic recovery does not get measured in years, but in decades. And we all know how quickly that can go pear-shaped. However, all of us should root for the right things to happen, that we become a winning country, that the economy perform, and that the rand remains strong. However, back to Rootstock. As I'm sure you're all well aware, my commitment and my family's commitment to Rootstock is unwavering. Rootstock manages the biggest portion of the family portfolio. However, time moves on, and some of you might say, Tace, you should start dyeing your hair because you've gone quite grey. So time moves on, and we need to make sure that there is longevity and sustainability within the business. And hence, from a succession point of view, I've largely handed over the reins to the team at hand. A team of talented individuals, dedicated and now experienced. I mean, Johan that you see on your screen and Francois Milan have been with Rootstock since inception, and the team had been augmented by the appointments of Harry Botha and Francois van Staden, and they've integrated well. So an experienced and dedicated teams. The team is performing well. And then we, every day of our lives, you can come and have a look on our website to see what our performance is, the performance of the fund is. There's really only one fund, so we've got nowhere to hide. Every day, our performance gets measured and we get compared to the rest of the market. We are very fortunate that we've decided to structure, because within financial markets, jargon can quite often confuse people. So we only have one fund. We have a simple investment philosophy and a clear process. So we've got a clear and concise and uncomplicated way of doing business. And the performance is there for everyone to see. So if we sort of cast our sort of minds forward, and we talk about the business as the fund management business, as you may know, the fund manager, not the fund, but the fund manager is largely still owned by the family company, our capital. But in time, we would like to dilute our shareholding to the individuals that make the difference within the business, i.e. those that deliver exceptionally. And that will be measured two ways. One is obviously growth in assets under management, and the other one is investment performance. So should the team succeed in doing that, and I've got a lot of confidence in their ability to do so, we will dilute our shareholding so that those individuals that make the difference become bigger shareholders in the business. I thank you for your attention. I'd like to hand over to Johan. We'll do the rest of the presentation. As I've said, there is a facility at the bottom to put in your questions. We already have received offline a number of questions, but feel free to put in questions. And with that, I'd like to hand over to Johan. Thank you.
Good morning, everyone, and thank you, Tace, for the introduction and the perspective on performance and operating environment. I'm going to talk a little bit about how we see the global investment environment and the underlying risks we are taking note of, and then importantly, some of the opportunities that's reflected in the holdings of the fund. If we look back over the past year, the recovery since the COVID crisis has really been remarkable. It took global trade and manufacturing volumes less than a year to recover back to pre-pandemic levels. And just to put this in perspective, if we compare to the global financial crisis in 2008, where global trade took about 3 years to recover, this really has been a very, very swift recovery. There are a number of reasons for this. The key ones are probably the size and the speed at which the monetary and fiscal support was introduced into the economy. And secondly, where the pandemic was an event-driven crisis with economic activity temporarily paused, where after the harsh lockdowns that we saw last year, the capacity was there to ramp up to full production again. If we compare this to the financial crisis in 2008, which really was a debt-fueled crisis, and it took companies and households a number of years to improve their balance sheets. This is not to say that the scarring will not be insignificant. It will most probably be smaller than what we saw in 2008, but it will still be significant. And global output, total global output, is only expected, excuse me, to recover to 97% of its 2019 levels. And then looking forward, I think the biggest risk to the recovery is probably virus mutations and inefficient rollout of vaccine programs. However, what we've seen so far is that the second and third waves, the economic impact has been significantly smaller than what we saw during the first wave, as individuals and companies have adapted to the new normal. If we look forward in terms of how we think the recovery will play out, excuse me, if we look to 2020, one can see that the US has performed relatively well compared to the rest of the world, GDP declining by 3.5%. The other outstanding performer was China, with its economy actually growing by 2.3%. And then at the bottom, the smaller emerging markets that really suffered and which didn't have the fiscal headroom to support those economies. If we look at the US, obviously, I don't think the pandemic management was that great. However, they really used all their firepower to support the economy with monetary and fiscal support. A place like China, again, really managed the fallout of the pandemic well, and managed to curtail infections quite well. Looking forward, we're probably going to see a similar sort of play out of events in terms of the developed countries and the ones that have managed the pandemics in an efficient manner, outperforming the laggards, which, as I've said, hasn't been able to support their economies. So the US expected to recover in 2021 by 6.4%, China 8.4%, and then South Africa again lagging at 3.1%. However, the two biggest risks that the biggest risk that we're seeing in markets is inflation and interest rates. And I think looking at the implied equity risk premium of the US market is probably a good way to illustrate this. The implied equity risk premium basically being the excess return equity market investor should expect for taking the extra risk of investing in equities relative to government bonds. So if we look at the implied risk premium at the moment, it's not that far out of line to what we've seen in the recent past. However, if we delve a little bit deeper into the detail, one can see that the long-term government bond rates are significantly lower than what they've been during the past few decades. So the biggest issue is most probably valuation. So the implied risk premium is driven by expensive valuations, but then also cheap interest rates or cheap money in the market. We are ever not that concerned for any sort of imminent crash. We think governments will continue to support their economies by means of monetary support and keeping interest rates low. Then post the sort of strong recoveries that we're seeing in 2021, we expect economic activity to normalize going forward to more reasonable levels. I think furthermore important point to make is just the positive deflationary effect that technology has had on inflation, and we expect that to continue to be the case going forward. On the slide, you'll see a Apple example of some of Apple's products. And going back to 1977, when the Apple II computer was first launched, in today's money, you would have paid $5,700 for that computer. And at the time, it only had 1 megahertz of processing power. Looking forward, or looking to the products that we get today, the recently launched iPhone 12, which cost about $800, has about 9.8 gigahertz of processing power. So that's a factor of 9,800 more than what you had in 1977. However, I think the important point to make is that if you look at a price per unit of compute basis at the bottom, it has been a 25% per annum, or remarkable 25% per annum decline in the price per unit of compute. Going forward, this most probably would not be as high a deflationary effect, but we do believe it will continue to have a positive impact on inflation. And then also, it's just not about the price deflation. One should also take into account the ease of use, how easy it is to use modern technology, the actual size of the products, the power efficiencies that they offer, and then also software enhancements. With a single piece of equipment, or iPhone, or a PC, one can really fulfill a lot of roles and really offers significant productivity and enhancements to its users. If we look a little bit about on the sort of opportunities that we're seeing, and many of these are reflected in the fund. Cloud computing is one of them that we sort of own with the likes of Microsoft, and Amazon, and Alphabet. But as we can see, the recent sort of growth in cloud adoption has really been rapid, and we think that sort of growth will continue as more and more users see the efficiency and cost improvements that the technology offers. Then also, if we look at the current adoption rates, it's estimated that only between 15 to 20% of potential users have adopted the technology. And going forward, we should have another 10 to 15 years of exceptional exponential growth ahead, with 80% of the sort of market penetration over time. This obviously bodes well for the likes of Microsoft and Amazon, that really has improved the efficiency and sort of business processes of many businesses. And we think as investors, one would really benefit from that. Another theme that we quite positive on is online advertising. And here we are just looking at the comparison between pay TV in the US and Facebook's sort of user base. If we look at the number of pay TV subscribers in the US, it's actually declined from 100 million to 83 million currently, whereas the cost per mile, or the cost to reach the audience, has actually increased from $680 to $850. In contrast, if we look at the Facebook example, users have actually increased from 200 million to 250 million during the same time period, while Facebook has managed to increase its average revenue per user from $29 to $164. And the cost to reach a significantly larger consumer base is a fraction of what you pay to reach those consumers on traditional media channels. And this, we think, this is a growing opportunity and a big market, and advertisers will continue to follow eyeballs. They'll advertise where people spend the most of their time. And if we look at the current sort of adoption rates in terms of online advertising, it's still only at 50 or 60%. And obviously, as the market, as these platforms grow, we do think the market will also grow in terms of the number of users that can be reached. Looking at how these opportunities are reflected in the fund, as you can see, information technology and communication services make up a very large portion of the portfolio. If we just look at the portfolio, the likes of Facebook, MasterCard, Alphabet really are the biggest holdings in the fund, and we remain positive on the opportunities that they have. I get the question a lot of times about the size of these companies. I'm sure many of them are very, very big companies, $1 or $2 trillion in market capitalization. However, we do think with the size of the market and the potential growth that we're seeing in that market, it's not unexpected that these market caps can go from 1 or 2 trillion to 5 or 10 trillion. So the market is big enough for these companies to continue to grow. And then importantly, I think we also continuously look for new opportunities. And if you look at some of the smaller positions in the fund that we've recently established, we're quite excited about the quality and the sort of interesting companies that we find and sort of allocate capital. A company like Lonza, which is a pharmaceutical contract manufacturer, and interestingly, they the dedicated producer of the Moderna COVID vaccine. Another one is Paycom Software, number 23, which is an HR and payroll software service provider, and really a significant improvement on traditional sort of products out there, and again offers significant productivity enhancements to the businesses that use them. And then lastly, NVIDIA, a semiconductor designer and graphics card designer. We do think as the world gets more and more connected, anything and everything will basically require some form of compute or processing power, and NVIDIA is in a prime position to benefit from that. To conclude, we remain conservatively positioned. However, I think we have seen a stabilization in economic activity, and companies that really sort of come through, or the companies at least that we own, have come through the storm much stronger, and we feel quite confident about their future prospects. However, we are cognizant of a multitude of risks out there, whether it's valuation and interest rates and inflation. However, we do not foresee sort of an immediate cause for concern. We will continue to stay true to our philosophy and follow our rigorous process, and we still believe investing in high quality businesses at reasonable valuations will offer the necessary returns in time. And then I think Thijs has touched on the sort of South African environment, and unfortunately our view remains that there are limited opportunities in this market. Unfortunately, we are a structurally low growth country, and as an investor in this market, one really need to rely on a re-rating potential. However, once that re-rating has happened, we think these businesses will continue to struggle to grow underlying profitability. And then, yeah, lastly, we continue to see new opportunities, and we're quite positive about the future, and I'm confident about the team's ability to find these new opportunities and offer the best returns for investors. So thank you for listening, and I think we'll open up for questions.
Before we move on to a question on the panel, Johan, if I may put a question to you, maybe talk about antitrust and regulation on big tech companies that we own, and why don't we, so how big a threat is that, and why don't we own Apple? And while you think about that, I would just like to dwell on one of the other questions that we've touched on, whether March 2020 was a missed opportunity, and what could we have done differently? And we all know that, and I think there was a wonderful ad some time ago, investments is really all about emotion. And it was Warren Buffett that said, when others are getting fearful, you should get greedy. And interestingly enough, for those that have listened to his annual feedback session, which typically happens in the first weekend of May, that even Warren Buffett basically missed the opportunity. He actually sold out of some shares at the time. So yeah, if we can keep emotion under control, and it's something that we constantly need to work at, and it's difficult to sort of just think back to where we were at about a 12-month period ago. Yes, that is a discipline that we all need to stick to. When everything seems to go pear-shaped, that's when you should use the opportunity. So what will we do differently next time? We will try and get our emotions under control as best as possible, buy when others sell and sell when others buy, which touches on the question that has come up under the Q&A, where the question is we have very little cash considering current levels in the market. But before we answer that question, Johan, maybe your comments on the antitrust and regulation of big tech companies, please.
Thank you, Jaz. I think obviously antitrust and the regulation is highly relevant and a big risk to these companies. However, I think many of the sort of market noise that we've seen out there, and many of the underlying sort of arguments against these companies, we believe is a storm in a teacup. All these companies offer are very innovative. The products and the software that they produce really sort of makes our lives easier. And we believe regulators will ultimately see that you can't sort of enforce antitrust onto companies that's successful because of the quality of their products and services. Following on from that, your question around Apple. Yeah, one of the reasons we don't own Apple is because of the antitrust. We think they're probably the most exposed in terms of restricting access to the App Store and sort of the excessive prices that they are charging for third-party developers to make their products accessible to Apple's user base. But then also, Apple has historically been a hardware producer, and we've sort of shied away from hardware producers. And I think just referring back to that deflationary chart, hardware in general becomes cheaper and cheaper over time and become more and more commoditized. So that's the one point. And the other point is Apple is becoming more and more reliant on their software or their services business, and that's where we think they're quite at risk in terms of regulation.
I'll attempt to answer the question in terms of 13.2% cash now, but Johan, you may want to think about how is the fund positioned in the healthcare sector considering the recent innovation in the sector. Going to the comment or question regarding the low percentage cash that we have, is I think that we need to also reflect on interest rates. So we are in an environment where interest rates are exceptionally low. So the return that you get for actually sitting with dollar cash is insignificant, firstly. Secondly, our view is that interest rates will remain low for quite some time, and that the risk premium that you get paid for to being in stocks makes it worth your while to actually be fully invested. So the 13.2% cash has actually been a drag on our performance rather than the safety measure. You want to comment on the healthcare industry, Johan?
Yes, I think there are a number of opportunities in the healthcare sector, and obviously this is a growing sector. However, we generally try and remain within our area of competence. So we're not biotech or pharma experts. So historically, we've shied away from those sort of complex and difficult to understand type of businesses. However, we have seen quite a few opportunities in the medical technology field where we've invested in the likes of Edwards Life Sciences, which produces heart valves, and then also with the recent investment in Lonza, which is a contract manufacturer predominantly to the biotech industry, and they've got about 2,000 clients that they serve. So one's getting exposure to the sort of fast-growing biotech sector without the risk of picking a single company which one thinks its sort of products will be successful and reach final sort of approval. So yeah, we continue to look at the sector, but more from a medical technology point of view rather than a pharma or biotech sectors.
One of the other questions that came up, what is our view regarding South African shares? Because international shares are expensive, where South African shares are cheap. Yes, we acknowledge that, but again, as Johan said, that those are re-rating opportunities, and I think I've used the Sasol example. I think that we need to guard against becoming too dogmatic. I think that the South African retailers offer some value. The banks obviously are still trading significantly below their previous highs. However, the one South African bank, and it's a very good example of where you buy a quality stock that's actually making new highs, is Capitec. So Capitec is by far the most expensive in the South African banking lineup. But I think that we still operate in a low growth environment, and that the opportunities outside of the South African environment is more significant. But I acknowledge that we can't be dogmatic about not taking South African shares, or some of them, into consideration. Johan, a question that came up: how is the portfolio positioned for a post-pandemic global economic boom? In other words, do we have enough sort of consumer-based and fixed investment shares in the portfolio?
No, we don't own a lot of consumer-facing and hardcore industrial companies. Again, I think that's relevant to the South African environment, I think, or sort of example, where we believe many of these companies can potentially get a short-term re-rating, but longer-term, the underlying growth in those businesses aren't that attractive. And we actually think some of the technology players offer reasonable value, but on top of that also have significant longer-term opportunities to grow their earnings. So no, we don't have a lot of consumer-facing business exposure.
Maybe just for the benefit of those that are on the call, or reflect a little bit, and while you think about it, I'll touch on value versus growth, but reflect a little bit on the recent company results that we've seen. So the big mega caps all reported back earnings growth, and I don't think our investors always are in tune with what the profit growths of those companies had been. These mega companies had grown their profits by exceptional percentages, and had been beating the market expectations. All of them had. But while you ponder on that, the whole issue, value versus growth, it's a long separate debate, and I'm sure you're all well aware that the value fund managers have underperformed to a great extent over the last while, and it's just recently, over the last, let's call it, year, that the value managers have been emerging as top performing managers. I think that when you pick a fund manager, you need to know what it is that you pick. And we at Rootstock won't change our investment philosophy because of economic cycles. So when you invest with us, you will have a growth bias, and hence the value, we won't be providing you with the value opportunity that you may require. So I would advise you to go and find a good value manager to augment the services that we are offering. Johan, comments on earnings?
Yes, I think, as you said, it really has been a remarkable result for many of the technology companies. And we must also remember that the base or the sort of levels at which these results are measured against already reflect sort of significant sort of growth that these companies saw during the pandemic last year. So it's not like the growth has really sort of tapered off. And yeah, something like for instance, a Microsoft, which is a $2 trillion company, to be able to grow their earnings by 40% really is a significant achievement. Going forward, one should probably not expect those types of growth or that type of growth. However, I think high double digits, sort of 15 to 20% growth is not unexpected for these companies for the foreseeable future. It's difficult to think that a company of that size can still grow at that rate. But that's just a function of the market and sort of as I've spoken to the sort of low adoption rates of some of the technologies that they offer.
And what did Google or Alphabet do, and what did Amazon do, just sort of broadly?
There's all of them between 15 and 40%. So it really was a function of very, very strong growth.
We've, I think, touched on most of the questions that we've received beforehand and looking at the screen. So we're about to conclude. I think the main issue, and I'd like to hear your thoughts on it, obviously, is we know that the discount rates obviously has a big impact on valuations, and discount rates is linked to the interest rate environment. For how long do we believe can interest rates move sideways or be as low as possible? Because we just saw 2 nights ago when Yellen spoke about potentially increasing interest rates, how the market had reacted. Comments on and conclusion on interest rates?
First, I think governments are incentivized to keep rates low for the foreseeable future, just to get the economies growing or going and to reach sort of full employment again. So it is a risk. However, I'm quite comfortable that the companies that we own, even if interest rates and the discount rate increases, the valuations might decline. But I'm confident that the underlying earnings will continue to deliver. So if I was concerned that they wouldn't be able to grow their earnings, I would have been much more concerned about the discount rates and the recent valuations. All of them have very little debt on their balance sheet, so increasing interest rates should not be an issue for them.
Just in conclusion, I think just to give investors and co-investors some comfort, we obviously monitor the sort of potential returns, or as we call it, the internal rate of returns of all of our shares all the time. So if either ratings go up or return profits decline, they slip on that table, and we would be selling out of those that we believe are too expensive or where we believe their earnings will decline, and vice versa. We'll buy those that offer value, and we'll buy the ones that seem to be cheap. Thank you very much to everyone. I see we've done it in 52 minutes for your attendance. As it has been commented on the side, we will distribute the slides to all attendees. Thanks, Johan. But a particular thank you to those that have taken the time to join the webinar. Thank you.
Thank you. Have a good day.